Starting with data center, another record was achieved in data center. Revenue of $30.8 billion, up 17% sequential.
Hello everyone and welcome back to the Cedi Investor. So I'm not recording myself today because I'm feeling a little bit unwell, but we've got to do the job, In today's video, we are going to look at the earnings report of Bank. They just released their Q1 2025 earnings report, and I think it will be something interesting to look at just because Access Bank is one of the stocks on the Ghana Stock Exchange that has been increasing, or a lot of people have been demanding to get that particular stock. So it will be interesting to go over their earnings reports, their financials, to see how the company is performing and if it's actually justified in terms of the stock price actually rising and rising and rising. So as you guys can see, from last week, Access Bank went up only 17.88% and is now 152.31% year to date, trading currently at 13.12 Ghana cedis. So if you wanted to buy Access Bank right now, you would need 13 Ghana cedis to basically buy one shares of Bank. So let's start with the income statement of Bank, and we can see that their interest income actually went up. It went up from 318 to like 384. The same thing happened with the interest expense. So even though they are increasing their interest income, the expenses or the costs related to the interest income is also going up. But all in all, they made way more in Q1 2025 compared to Q1 2024. You can see that the net interest income has gone up from 124 to 136. So now let's look at their other revenue source, and that's the net fee and commissions. We can see that it also went up from 147 to 233. So basically all their revenue sources are going up. For other operating income, also slightly down, but all in all, their total operating income is up compared to last year, Q1 2024. So I think that's okay, good to see. So all in all, from a revenue standpoint, they actually increased their revenue from Q1 2024. We can see it went up from 394 to 450. Now let's look at the expenditure involved with making those revenues. We can see that personal expenses went up from 49 in March 2024 to 71 in March 2025. Depreciation also went up, and other operating expenditures also went up from 42 to 41. So the rate at which the expenditure is increasing was almost at par, if not even way higher than the rate at which their revenue is increasing. So on first thought, I don't really like seeing this. If your expenditure or your cost of sales are increasing at a higher rate compared to your revenues, to me, it really puts me off. I don't want to see your expenditure increasing higher than your revenue. So you can see that their profits before income tax, even though they increased their revenue for Q1 2025 compared to Q1 2024, they ended up making lesser profit before tax compared to the same period in Q1 2024. So after taxation, we can see that profit after tax is actually less compared to Q1 2024. So basically, it just means that you are increasing your revenue, which is a good thing, but your costs and expenditures are also increasing at a high rate, eventually reducing the actual profits the company is going to earn. And I can see that being reflected in the earnings per share, seeing it being more diluted. The company is earning less for me as a shareholder compared to last year. So that in itself is very, very bad on my end. Let me know what your thoughts are, but I don't think it's looking good. Now let's look at their financial statements. We can see that the cash reserve position actually went up, which is good. I like seeing that. The investments in securities went a little bit down. I would probably want to go through the notes to really understand why. Okay, maybe probably it's because the loans also went up. So my thoughts when I see this is because probably maybe the yields on investments are not that high compared to last year, and also because the government is putting a lot of restrictions to prevent banks from just investing in securities. The government has put in place a regulation where it says if you want to invest more in securities, you also have to have some higher level of cash reserve ratio, so it makes it difficult for banks to do that. So I think they are now exploring other investment opportunities like lending more to businesses and customers. So I think that's okay. So all in all, they good their assets, but they also good their liabilities. I do like the fact that at least total equity is increasing. They're at least trying to retain some earnings for as the investors, but I don't like seeing their cost being so high. So now let's look at the quantitative disclosures. We can see that the capital adequacy ratio actually went down. Not a good sign for me. The capital adequacy ratio shows how financially sound a bank is. So seeing that percentage go down is not really good on my end. And the MPL actually went down, so that's actually great. I like seeing that. I want to see that loans are performing well. I don't want non-performing loans where you are giving loans to people who might default, but actually you are giving the loans to people who 100% are likely to pay back those loans, ensuring that the banks actually make revenue, increase their revenue, and actually are able to reinvest back into the company. So I do like that fact. I also like that at least they are keeping some, or they are increasing their liquidity, trying to increase their cash position, trying to increase their current assets compared to their current liabilities. So that's also good to see. Up next, let's look at the ratios of the company. We can see that the PE currently is at like 4.27, and that's way high compared to its historic EP. We can see that the highest it has ever been over the past 5 years was 2020, and that was like 3.17, but currently it's way above that. So essentially it just means that you are paying way more for the company compared to what you would have 5 years ago. When we look at the price to sales ratio, we can also see that it's also quite high compared to its previous year. It means the amount you are paying for each sale that the company makes is at the highest that's ever been. And the same can be said for the price to book ratio, which I really like looking at this when it comes to bank, because it actually shows how valuable the bank is. This basically shows how expensive, all these three ratios are showing how expensive this bank is right now, or it's showing how the bank is trading at a premium. Now another thing I like looking out for is return on equity and return on assets, because I want to see how efficient the company is with money. I want to see how they are returning money back to me as a shareholder, and they are also making returns with money or capital that the business has itself. Over the past 3 years, we can see that the return on equity has been reducing. So far this year it's below 2024, so I'll probably have to wait to see how the year ends, but I don't like seeing that figure reduce. It was negative in 2024, but since then it has gone up. It's like it's coming back down, which I don't really like that. I want to see a trend upwards, not downwards. When we look at dividends, Cow Bank hasn't paid dividends since 2022, so we'll wait to see if they do announce dividend for this year, but it's looking unlikely. So that's basically it for the Q1 earnings report from Access. What are my final thoughts? All in all, I don't really think that the earnings of Q1 2025 justifies the current share price for Access Bank. I didn't really do a DCF for the bank because DCF can be very deceiving when it comes to bank, because banks really have free cash flow on hand. Mostly it's negative free cash flow because they are very highly leveraged. They are companies that actually use borrowed money to make money. So it will be deceiving to do a DCF, but I do have a method to determine if the price of a bank is attractively priced or not. So I'll probably maybe talk about that in another video. When we look at the PB, for example, a ratio like the PB ratio, The PB ratio, like I said earlier, it shows the net assets or the net worth of the actual underlying net worth of the company, and we can see that it's increasing, or it has increased so much. So the only way to justify that is, one, we're expecting continued higher growth to justify us paying above the current worth or the current net assets of the company, or two, that the company is massively overpriced. And I'm a big believer of the latter, because when we compare Access Bank to a company like GCB, for example, GCB, I think, in my opinion, is a way better company when you compare it to Access Bank in all categories, in terms of revenue, in terms of operating income, in terms of net profit, in terms of the return on assets, return on equity, dividends payments, in terms of earnings growth, in terms of cash position. I'll probably have to look at the MPL and CAR to really know if they do beat Access Bank in those areas. But even in terms of earnings per share, like in every single area of the business when it comes to the banking, I think GCB just way outperforms Access Bank. And to see GCB trading at a lower price compared to Access Bank, I think it just shows how high of a premium that Access Bank is trading at the moment. So if I was to make a decision on buying Access Bank, I would rather probably invest in a bank like GCB. But then that is my opinion. Let me know if you do own Access Bank, your reason for owning it, or if you are selling Access Bank. I'm really curious to know you guys' perspective on this particular stock, but I don't think the earnings report justifies the share price. I really think the only reason why it's going up is because of demand. People are seeing the price going up, and they are feeling probably a little bit left out. So they are trying to get into it, hoping they can make a quick return. And we are just in Q1, so you would be betting a lot on this company to continue delivering to justify you buying it after a 152% return year to date. But that is my opinion. Thank you so much for watching this video. I would really appreciate it if you guys could leave a comment down below, if you could subscribe to the channel, and also like or share to people you think might be interested. Hopefully I'll be better, and I'll come back with another video at the end of the week. Thank you so much. God bless.